Today we're reviewing every type of dividend tested on the CPA exam. The biggest rule to remember is this: dividends are distributions to owners, not expenses, so they never directly affect net income. Most dividends reduce retained earnings. However, liquidating dividends represent a return of contributed capital rather than retained earnings. The accounting depends entirely on the type of dividend, so let's review each one. We'll start with cash dividends, the most heavily tested. A cash dividend is simply a distribution of cash to shareholders. There are three important dates: the declaration date, the record date, and the payment date. The declaration date is the most important because this is when the board formally approves the dividend. A liability is created and retained earnings decrease. The journal entry is debit retained earnings and credit dividends payable. The record date simply determines which shareholders are entitled to receive the dividend. There is no journal entry on the record date. The payment date is when the company actually pays the dividend. Debit dividends payable and credit cash. Remember this phrase: declaration creates the liability, record does nothing, and payment removes the liability. Next are liquidating dividends. These represent a return of the shareholders' invested capital rather than a distribution of earnings. A liquidating dividend is the portion of a dividend that exceeds available retained earnings. That portion is charged to contributed capital, typically additional paid-in capital. Think of it as giving shareholders back part of their original investment rather than distributing accumulated profits. A liquidating dividend is not an expense and not revenue. Remember, return of capital, not return on capital. Now let's discuss property dividends. These distribute non-cash assets such as land, investments, or equipment. Property dividends are recorded at the fair value of the asset distributed, not book value. There are always two steps. First, remeasure the asset to fair value by recognizing a gain if fair value exceeds book value, or a loss if fair value is less than book value. The gain or loss is recognized in continuing operations before the dividend is recorded. Second, record the dividend itself by debiting retained earnings and crediting property dividend payable at fair value. When the asset is distributed, debit property dividend payable and credit the asset. Remember, property dividends always require a fair value adjustment first. Next are scrip dividends. These are simply promises to pay dividends later, usually by issuing a note payable instead of paying cash immediately. They are low priority on the CPA exam, but know they create a liability. Now let's move to stock dividends, another favorite exam topic. A stock dividend distributes additional shares instead of cash. No cash leaves the company, there is no gain or loss, and total stockholders' equity does not change because this is simply a reclassification within equity. The key question is whether the dividend is small or large. A small stock dividend, generally less than 20 to 25%, is measured using fair value. Debit retained earnings for fair value, credit common stock at par, and credit APIC for the excess. A large stock dividend, generally greater than 20 to 25%, is measured using par value only. Debit retained earnings for par and credit common stock. No APIC is recorded. Remember, small equals fair value, large equals par. A very common exam trap is confusing a stock dividend with a stock split. A stock dividend requires a journal entry, decreases retained earnings, and increases the number of shares outstanding, while total stockholders' equity remains unchanged. A stock split also increases the number of shares outstanding and leaves total stockholders' equity unchanged, but there is no journal entry. The number of shares increases while the par value per share decreases proportionately, so total par value remains unchanged. Think: stock split equals no journal entry. Stock dividend equals journal entry required. From the investor's perspective, receiving a stock dividend is not dividend income. The investor owns more shares, but the cost basis per share decreases while the total investment value stays exactly the same. Think of cutting the same pizza into more slices. The number of slices increases, but the amount of pizza stays exactly the same. Next are stock rights. Stock rights give existing shareholders the option to purchase additional shares, usually below market price. If rights are issued without consideration, there is no journal entry because nothing has been exchanged. There is no change to common stock, APIC, or retained earnings. When rights are exercised, debit cash, credit common stock at par, and credit APIC for the remainder. If the rights expire, there is still no journal entry because the option simply expires unused. Remember, no consideration equals no journal entry. Finally, let's review preferred dividends and dividends in arrears. Dividends in arrears apply only to cumulative preferred stock. They are not liabilities until declared, so they are disclosed in the footnotes but not recorded. Non-cumulative preferred stock does not carry unpaid dividends into future years. If a dividend is skipped, it is lost forever. Cumulative preferred stock carries unpaid dividends forward as dividends in arrears, and those unpaid dividends must be paid before common shareholders receive any dividends. Always remember the allocation order. Preferred shareholders are paid first, then common shareholders. Let's finish with a rapid-fire review. Cash dividend equals cash. Property dividend equals fair value. Liquidating dividend equals return of capital. Small stock dividend equals fair value. Large stock dividend equals par. Stock dividend equals journal entry. Stock split equals no journal entry. Stock rights issued without consideration equals no journal entry. Rights exercised equals cash, plus issue stock. Dividends in arrears apply only to cumulative preferred stock. One final CPA exam reminder. Stock dividends and stock splits are applied retroactively when calculating weighted average shares outstanding for earnings per share, as if they occurred at the beginning of the earliest period presented. Cash dividends and property dividends do not affect weighted average shares outstanding. The one sentence I want you to remember for the CPA exam is this: dividends distribute value to shareholders, not expenses. They reduce equity, never directly affect net income, and the accounting always depends on the type of dividend being distributed.